Hello everyone. Today we are diving into a crucial institution that keeps the heart of India's financial markets beating. The Securities and Exchange Board of India, better known as SEBI. Now, why was SEBI needed? Why did this become an extremely crucial institution? Let's rewind back to 1992. India had started its process of a massive transformation. The liberalization, privatization, and globalization or LPG reforms had kicked off. The economy was opening up, getting privatized, with the license Raj coming to an end, and private companies getting established in businesses across all sectors. Foreign investors were knocking on the door, but at the heart of all this was one big question. Can we trust the Indian capital markets to be safe, transparent, and well regulated? Because all that capital and money would have been needed to establish and run all these businesses. And this is exactly where SEBI enters. Established under the SEBI Act of 1992, it was India's answer to all investors seeking financial stability and regulatory clarity. But SEBI didn't rise to power overnight. In fact, SEBI got its first real moment in the spotlight thanks to a scandal. Yes, the Harshad Mehta scam of 1992. It was unearthed by a journalist, Miss Sucheta Dalal, in a Times of India column. For some reason, the person has been portrayed as some kind of hero. However, he wasn't one. The scam exposed massive loopholes in our banking and securities system. The parliament had to act fast. And therefore, in April of 1992, the SEBI Act was brought into force and SEBI got its statutory powers. It was because SEBI was earlier established as a non-statutory body in 1988 with no legal backing and major powers as such. Now, the major objective of SEBI is to protect the interest of investors in the securities market and to promote the development of and regulate the securities market. Now, this objective is extremely crucial because there are times when SEBI has to choose between commercial considerations and commercial viability of things that people in the share market or capital market have to do. And on the other hand, there is the consideration of investor welfare. SEBI, as per its objective, why it was established, has to go with the latter, that is, investor protection. These considerations become relevant, which we'll discuss in the course as well. But moving on for now. SEBI frames regulations that govern market conduct. There are many such regulations that are made. One of those regulations is the listing obligations and disclosure requirements regulations, which was made in the year 2015. The regulations ensure that listed companies, the ones listed on the stock markets, regularly disclose all material information, which is the earnings or the profit and loss that the companies have made every quarter, the shareholding pattern changes, that who has become the shareholder or not, the key board decisions, basically anything that could affect the share price or investor decisions. For example, if a CEO of a company or any CXO resigns, it is a major deal for any investor. If on the positive end, a major deal is signed, investors deserve to know. LODR regulations, as they are commonly known, make sure that the investors do. It is important because all such information can materially affect the company's share price. It can make it rise or fall by just that one announcement. And therefore, these disclosures are important and SEBI has made regulations for them. The second thing that SEBI also issues is circulars. They are like mini guidelines that clarify or update SEBI's rules. For example, in 2025, SEBI released multiple circulars relating to the launch and framework of specialized investment funds, which is a new kind of fund that SEBI has launched, in addition to mutual funds, AIFs, etc. Now, these circulars are frequent and they address practical market concerns. Further, you will also see master circulars on issues, which basically consolidate several circulars which have come out in the past under this one head or one roof for ease of compliance. At that particular point, whatever circulars have come before that are compiled into one document for any company or capital markets intermediary. Another important thing which you will need to read and rely on while advising clients are informal guidances issued by SEBI. They are issued to companies and intermediaries. These intermediaries and companies ask SEBI about issues in the regulatory gray area. It is similar to the advanced ruling system in tax law. The basic underlying principle is prevention is better than cure. So all these companies, they want to seek the opinion of the regulator beforehand itself so that there is no clash or problems later. Coming to the quasi-judiciary role of SEBI, SEBI also passes orders after investigations. Take the Gensol engineering case in April 2025, where an interim order was passed barring the promoters of the company from accessing capital markets. There are two types of orders broadly passed by SEBI. One, hold time member orders or WTM orders, and second, adjudicating officer orders or AO orders. While one kinds of orders are majorly meant to impose penalties on the person or company in question, the other kinds of orders are remedial in nature. Now, once SEBI has passed these orders, if someone disagrees with SEBI's orders, they can appeal to the Securities Appellate Tribunal or the SAT. Also, SAT decisions can further go to the Supreme Court, however, only for questions of law. This layered system ensures checks and balances. Now, coming to the last role, wherein companies file their offer documents with SEBI and they are provided on SEBI's website, wherein all the public investors can look at these documents before investing in the company. The classic disclaimer which all of you would have heard after a mutual fund's Sahi Hai ad comes.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Or any company has their offer documents being advertised on any news channel, this disclaimer is meant to provide safety to the investors. For accessing these documents which have been filed by SEBI, you can go to the Filings tab, and in the Filings tab, there are all the different kinds of issues which can be made by companies. The IPOs or the public issues which a lot of companies do, they come under the head of public issues, wherein first the draft offer documents are filed with SEBI, and thereafter once they are confirmed, the pricing band is fixed at what price the shares are going to be issued, they are converted into the final offer documents on the basis of which the company raises money from investors. And lastly, it is important for you to understand how SEBI makes these laws. What is the process behind it? So first, SEBI releases something called a consultation paper on a particular issue, wherein it requires all the market participants to send their opinion, their point of view, if they are directly affected by it or not. So law firms, students can also send their views regarding that particular issue. And if the law is passed in the manner in which it is written in the consultation paper, what effect would it have on the capital market? Thereafter, SEBI deliberates on all these public comments that it receives and finally announces to the market laws and regulations that it has made in something called a SEBI board meeting. Which is extremely crucial. It happens once a quarter, wherein SEBI announces all their new laws and regulations that it has made after due consultation with relevant market participants. So that's about it regarding the different roles of SEBI, as well as the different kinds of documents that you would have to read and rely on while navigating the regulator's website. If there are any other doubts, you can mention them in the comments. We'll be more than happy to help you.